Good morning, and for some of you, good afternoon as well. My name's Justin Metcalf, and wanted to just kick off the Forvis Mazars Pillar 2 technical series. This is the first of 10 forecasted webinars that are coming. Today we are going to talk about the overview of the globe rules today and the transition years that we are in as we speak today. So in the next 2 weeks, we'll cover multinational enterprise groups, and that will be with Danae Fillion, Carolyn Boachman, and myself, and Neil Rolfe. Without further ado, I am one of the presenters today. My name's Justin Metcalf. I'm a director with the Charlotte, North Carolina office of Forvis Mazars, and I will let Neil here introduce himself.
Yeah, thanks. So I'm Neil Rolfe. I'm the head of insurance tax globally for Forvis Mazars. Insurance was one of the first affected industry groups by the globe rules. And when I joined Forvis Mazars 3 years ago and had fewer client commitments, I got quite stuck into that. And as a result, I've ended up, along with Justin, leading our technical and training efforts from a Forvis Mazars perspective. So we're both part of the executive committee. We both receive quite a lot of the technical questions that we receive as a group. Should you have any technical questions, either as part of this presentation or as later ones, please do feel free to reach out to us on the email addresses there. So then if we look at the overview, so this is intended to be, all of these sessions are going to build a reasonably, I wouldn't say it's a fully in-depth into the rules technical answer for everything, because that's not possible within the time that we have available, but it is supposed to be more than just a gloss over the surface. And so we're going to firstly look at, well, what's in scope, what's the very first thing you've got to look at. So you've got to look at whether or not you're a multinational enterprise group. The trigger is 750 million euros, it being an OECD measure, so it's in euros rather than dollars, in 2 of the last 4 fiscal years prior to the tested year. So if the tested year is, say, 2024, as it is in the UK and across most of Europe, then you're looking at 2 of the last 4 years before that, so 2021, 2, 3, right? The purpose of it, it's looking to ensure that there's a minimum tax rate in each jurisdiction, so it's tested by jurisdiction. This can be difficult for those groups with multiple divisions because you have to add the divisions up. And it's looking to see ultimately whether it's in the division, there's a charging mechanism somewhere in the world, even if your jurisdiction hasn't yet implemented the rules. And obviously this is highly contentious, particularly as far as the US is concerned. There's double level of complexity in the top-up tax computations. We'll cover this, the temporary, potentially then permanent safe harbors and what you need to do to get into those, much more simple calculations than the full model rules, which we'll also cover. And then there's interaction with existing top-up tax legislation or minimum tax like CAMT, and also the CFC rules. There's 3 main charging provisions. Well, here we have them sort of split, but actually income inclusion rule and QDMTT mostly go together. So QDMTT we think of, so I always think, and I did a presentation on this earlier today, so pillar 2 in sort of triangles with the ultimate parent entity at the top. QDMTT allows jurisdictions to protect their own lunch, right? So if you are in a QDMTT jurisdiction, you have to do a calc for that jurisdiction, but any top-up tax due is collected by that local revenue authority. They protected their own lunch. IRR is, we call eating the children's lunch. So again, in the pyramid, the top company, the top jurisdiction tests all of the subsidiary jurisdictions, and if there's top-up tax due, the tax authority at the top eats that lunch. And UTPR, which is the sort of sting in the tail, really, of these whole rules and the reason why they're being implemented across the globe, is they eat the whole family's lunch. And here you could have the UK being maybe only 2 entities or 1 entity as part of the whole group, but the UK will take top-up tax and have to do a top-up tax calculation from 2025 for the entirety of the worldwide group. It will have to do reporting in 2024, but it will have to collect tax in 2025. And that's the reason why many jurisdictions are joining who you wouldn't think would be interested in such an approach, because if they don't protect their own lunch, then someone else eats it for them. So the OECD see that as a way of persuading the entire globe to fall into line. Justin, I don't know if you want to go on to the...
Yeah, so I mean, we have this top-up tax, and what I think, to Neil, what your point is saying is these 3 charging mechanisms really give the Pillar 2 rules teeth, right? This is, there's generally a thought of that, hey, there's one top-up tax, for every jurisdiction in the world, whether you're in there or not, and the IIR, the UTPR, and the QDMTT are basically the mechanisms as to how that tax is actually collected by jurisdiction. So these rules that have actually, just to give us kind of an overview from how we got here, right? So, in the G20 summit back in 2021, over 140 member states agreed to adopt, the OECD BEPS Pillar 2, which had been, it had been evolved into different rules and different proposals, but that was the first moment where Pillar 2 kind of became a reality. December of 2021, we then got model rules that give us basically a whole new framework on how to think of Pillar 2 as a new taxing regime. A year later from that, we got safe harbor test guidance, and then all through last year, we had 3 different administrative guidance and clarifications released by the OECD that kind of allude to different aspects. Some of the notable ones in February, there was guidance on how to treat the U.S. GILTI regime, its taxes, and how to allocate that, because the GILTI regime in the U.S. is really entity by entity, and you need a mechanism to kind of figure out how to do that from a jurisdiction by jurisdiction basis, which the globe rules are stringent upon. The July guidance gave us QDMTT safe harbors, and later today we'll talk about what makes a QDMTT, a qualified domestic minimum top-up tax, a qualified one. But there is a QDMTT safe harbor that was released in the July guidance that would alleviate any incremental top-up tax if that was comported with. And then in December, we had new rules for the transitional safe harbor that came out that talked about hybrid arbitrage arrangements and making corresponding adjustments to your calculations. And then as recent as, maybe not so recent, but in June 2024, we had more guidance on how you allocate, current and deferred and do the push down. So quite a bit of guidance, and I don't think this is the last of it. There was also an XML schema release for the Globe Information Return. So there's that as well. So you could see that the OECD is making these rules up, and issuing clarifying statements as jurisdictions are adopting. So for those that are wondering, yes, Pillar 2 is very real. I'm sure most people here understand that. So I won't waste your time talking more about that. So without further ado, I'll kick it.
I mean, I'd just add to that, I think, Justin, so we, in the UK, we had a 2-hour meeting with the UK revenue authorities on the implementation of Pillar 2. I think we were the first of the advisory firms to have that meeting last week. And they were saying there's still a lot of things to decide and to come out. I guess the most notable one that everyone will be interested in is the permanent safe harbors, assuming that there are some, and all indications that appears to be the case. Certainly the German OECD member at a conference that one of our people attended recently guaranteed that that would be the case. Obviously, we haven't seen the form of that yet. We don't know whether it will be based on CBCR. They previously ruled that out. I think there's also a lot of additional stuff around, how any disputes between authorities will pan out, and also, how we get a properly global GIR, group information return. So, like you say, we've gone a long way over the last 3 years. It's already very real for a lot of people, but the final shape of it continues to evolve, and that's what makes it quite difficult to pin down for many clients.
So, let's talk real quick about like a step plan on how you attack Pillar 2. So, we talk about this top-up tax and how, you have the IIR, the UTPR, and the QDMTT that basically are mechanisms to collecting it. So, and this is a very watered-down version of how you address Pillar 2, but there's these 5 steps you have to follow. First, you have to understand your multinational enterprise group, because how else are you going to understand, who comes in, who comes out for your calculation? How are you going to measure the revenue threshold of 750 million euro in 2 of the last 4 years? So that has to be the first. The second here, and we won't spend too much time on this, right, is you have to figure out your globe income or loss, right? And this is basically your Article 3 under the OECD model rules. There's, in the U.S. And in other tax regimes, everyone has their own taxing regimes. You always think about book to tax, like in the U.S. context. Here, this is a complete different regime. So I like to think about it, coin it as book to globe. So, different taxing rules. Some kind of follow here and there, but for the most part, there's some differences. So this is very much a new tax regime. Step 3, you figure out your adjusted covered taxes, because this is going to be your numerator, right, to the equation that we'll talk here in a bit. And that's really talking about figuring out your Article 4 under the OECD model rules. Once you've figured out those 2 components, you can basically start cooking the sausage, basically, and that's step 4. You can plug in your elements and follow the Article 5 mechanisms and calculating what is my top-up tax. Do I owe any top-up tax? At this point, you would consider what we'll talk about later, substance-based income exclusion amounts. And then once you figured out whether you owe a top-up tax or you have a top-up tax, then basically, you have it, to Neil's reference, the lunch is on the table, and then basically everybody gets to decide who gets to eat what. So with that, I think we'll kick it to
I mean, each of these, we're going to cover each of these at a really high level in this sort of overview session, but then each of these sort of component parts is going to be covered in more detail as part of the later sessions, part of the 10, the 9 subsequent sessions run on a fortnightly basis that we'll be offering. So I think we're moving to a polling question now. I think I click on this, and then the polling question should go live. So here we're looking at the sort of group information return. So this is whether or not you've actually done an assessment already. Are you in scope for the rules? I think that's the intent of the question, isn't it, Justin? Yeah. So it's like,
that's right.
We've found, so there's a deeming provision. So it talks about consolidated revenue. We found that actually some groups are within scope even if they don't do consolidated accounts, and this is particularly true, we've seen, of both trust structures, which are sort of special case, and also, some US, let's say family-owned groups, they've got an exclusion from producing consolidated accounts at the top level, but even though they don't produce accounts, this deeming provision, which, that you might not even do country by country report, you don't think that you're within the scope of the rules, but because you've got control underneath it, and because this is all an accounts test, So there we go. So there's a bit of a broad spread: 29% yes, 29% no, 42% not sure. Yeah. So I think that just goes to show, right? Everyone's at a different state of preparedness on this, and it you know it gradually creeps up, I think. So I think that's quite interesting, that one. So then if we move back into the subject.
So yeah, let's talk real quick. You know, we talk about this jurisdictional top-up tax that Pillar 2's thrown in, right? So Article 5 of the model rule says you're basically, and this is, you know, the next few slides are going to be, you know, kind of a picture view of what the globe rules look like. And I like to think about it more like a forest view, not a trees view. And what I mean by that is, you know, it's not super detailed, but it'll give you an idea mathematically and computationally how all this comes together. So for every jurisdiction, the top-up tax liability will be equal to your top-up tax liability in the current year, and we'll talk about what makes that component. Any additional current top-up tax, which is usually kind of their the mechanism of collecting any restatements. You know, if there's like restatements or additional top-up tax that's attributable to other periods, it's collectible in the year where it's corrected, and then less any QDMTT. And that's, you know, we said earlier, QDMTT is a charging mechanism. You know, in many ways maybe it's not, but if you see how the math works, basically the QDMTT will offset any top-up tax. So it's really at the first pecking order. So in many ways, it may not be described in Article 5 as a charging provision, but in a, you know, see between the lines, a metaphor, it really is the first in line. So with that said, let's talk about how the top-up tax is done. So,
cool.
Oh, sorry. Here.
So we both did that at the same time. Yeah.
Yeah.
This is the slide we left, yeah.
So the top-up tax liability. This is where you hear people talk about being in the full scope globe calculation, and you know you hear references about the 252 data points out there, and you know it's roughly around that. You know, different firms have different views on it, but we just know it's a whole lot of data, right? This is the mechanism where that data is plugged into, and basically your top-up tax liability for a jurisdiction is equal to the top-up tax percentage multiplied by the excess profits in that jurisdiction. To figure out each and every one of those, you can see here you take the rate today with a 15%, and you compare that to your globe jurisdictional ETR, which is comprised of your Article 4 adjusted covered taxes as your numerator, and your Article 3 net globe income or loss as your denominator. Ironic enough, you know, net globe income also serves on the backside, on the other end of this, where you back out, you get a carve out, and you know, this slide deck right here is saying 5 and 5. That's where eventually the rules go. But starting today, it's at 10% for eligible payroll expenses and 8% for eligible tangible assets. So, and eventually they just cascade downward to 5 and 5 at an eventual point. So that 5%, you know, is a little different today, but eventually that's where the rules are headed. Let's talk a little quickly on what makes net globe income. So net globe income is basically your financial accounting net income or loss, FANL, right? Then there are globe adjustments, right? And in those globe adjustments, you have two different categories. You have like the specified ones that are directly stated in Article 3, and then there's other provisions in Article 3 and the globe commentaries. And actually, there was one introduced in the February guidance for debt releases in there that are kind of like add-ons that have happened post the model rules. And then there is this exclusion for international shipping income that's tailored to a very segmented sector. And that's basically how you get to your net globe income. And again, All this is covered under Article 3, and we can be here for hours, and there will be other segments in this series that really pierce layers of the onion of what makes us. But again, today is an overview, so we're just kind of scratching the surface. We're not diving into the full detail, so stay tuned. The next component here is your Article 4, the computation of adjusted covered taxes. Here you take your covered tax expense. This is really taxes on profits. They don't include Pillar 2 taxes in there. There's a component here where there are certain enumerated additions and reductions to covered tax expense. There's a mechanism called the DTAA, the Total Deferred Tax Adjustment Amount, which is basically, it's a mechanism to address temporary differences. You'll see, here's where you have DTL fluctuations, and there is this thing under Article 4.5 about a globe loss election that allows you, if you make that election, and we again in this series we will have a segment on all the elections as well. This is the first of 10. That allows you to basically take the globe loss election in lieu of the DTAA, and then to the extent you have items that are not that are recorded in OCI and equity, and you have to make the rules require you make certain adjustments to your tax expense to account for those as well. So that said,
I think I can't remember exactly how many we did add up. We did an Excel spreadsheet looking at all the adjustments in the model rules that you had to make in order to adjust your FANL, and then another one to look at all the adjustments you could potentially have to make in order to get to your covered taxes. And I think it's something like 25 and 32 or some, that's not the exact numbers, but it's some similar sort of number to that. It's quite a lot of numbers there.
Yeah, that's right. And it's basically a very, it's a new regime. And then, we talk about the carve out. So we'll talk, I mentioned earlier, the rates change, right? This is basically, for those that are in the U.S. and understand the U.S. GILTI regime, this is very, very much correlated to how our GILTI regime works when you have net deemed tangible income return. You get a 10% return on a QBI. Similar mechanics, but different targets. Here you get two. You get an eligible payroll expense carve out, right? And you get an eligible tangible assets carve out as well. And you can elect out of doing both, right? If you don't want to go through the data exercise, the rules require that. And I mentioned earlier the 10 and the 8, right? And eventually we get down to 5 for that. But keep in mind, like, it's important, and we'll talk about this in future series, that certain payroll expenses, it's pretty broadly defined in the GLOBE rules. Like you can include like contractor expenses if they are, for example, at the control of the company. So things like that are permitted in eligible payroll costs. Eligible tangible assets, there's interesting items like a license with respect to government immovable property. So when you're doing these calculations, it's important to make sure when you're scrubbing your data to really understand what's going on, between what's actually happening with the company you're in and how that's translating into your recording on the books. That said, I think we are at a So Neil, you want to take this here? This is kind of like a pie view of the full pop-up tax.
I think it's like we've said before, right? So QDMTT is the first part where people get to keep their own lunch. IIR, then in the early years, that's what allows people to take the next slice, but then ultimately UTPR is going to come in, from next year and make sure that 15% is chargeable across the world.
Yep. So, and the ordering here is, QDMTTs come first. And again, we mentioned it wasn't a charging mechanism, right? But we do call it, in many ways it is, just seeing between the lines. QDMTTs dictate first, IIRs soon thereafter, and then UTPRs kind of eat everyone else's lunch. To kind of articulate how this works, we're going to go through a quick example, right? So, let's use a quick example. Let's say we got a U.S. UPE. It owns a Netherlands BV. Netherlands BV owns UK and Bahamas. US LLC owns Canada. Let's make some quick assumptions here. Let's say US and Bahamas have not done anything with respect to Pillar 2. And let's just say Netherlands, UK, and Canada have adopted all three charging mechanisms, right? They have a QDMTT, an IIR, and UTPR. To understand how this works, we have to first ask ourselves, we have to agree that everyone in this org chart, regardless of whether you've adopted Pillar 2 or not, is going to have to do this calculation to figure out, is there an owed top-up tax? The question is, who just gets to collect that top-up tax based on how the Pillar 2 rules work? So starting with our ordering, we know the QDMTT comes first. The first order here is Netherlands, UK, and Canada will have had a QDMTT that collects their fair share of top-up tax, and presumptively there will be no incremental top-up tax because their QDMTTs all follow the globe rules perfectly. And we'll talk about the potential leakage later. Dutch Co will not collect anything on behalf of, Bahamas won't collect anything and US won't collect anything under the QDMTT because they haven't adopted anything. And we'll talk about CAMT later here as well. That being said, we know US and Bahamas are kind of delinquent on their top-up tax. So the next mechanism here is the IIR, which comes into play. So you'll notice that the US is the ultimate parent entity of this multinational enterprise group. But we know today that the US has not adopted an IIR, and it's, I think it's probably it's tough to see. Tough to see what we'll have to wait after the election to see what happens there. But it's tough to see what that happens. So what the rules say is you go down the org chart until you find somebody that has an IIR, and then ask yourself, who below does that entity that has an IIR in its jurisdiction have any low tax constituent entities under it? And here we have Dutch Co BV that owns 100% of Bahamas, and we know Bahamas has nothing, and it's a low tax constituent entity. So what will happen here is Dutch Co BV will collect the top-up tax on behalf of the Bahamas. And then that means the U.S., is still, Scots free and clear. Next mechanism here, the U.S. is the only one here that hasn't collected anything, and that's where the UTPR comes in. So the UTPR, right, will basically allow every jurisdiction that has adopted a UTPR in its own local country laws to deny either sufficient deductions to make sure that the U.S. here has been topped up to 15%, or will, through some other mechanism that is contemplated in the OECD rules, add some component that allows you to collect top-up tax on behalf of the U.S. So, that said, there's this rhetoric about the U.S. hasn't adopted Pillar 2, so why do we care? This is usually where people start to see this is why it matters in the U.S. Usually that the UTPR in 2025, when it comes into effect, January 1st, 2025, I think South Korea is the first one that will, push it out, and it'll go effective. Some others have followed, but here is where, it starts to affect the U.S. So that's kind of an overview of how the top-up tax works, high level, right, and how these charging mechanisms, the IIR and the UTPR and this quasi-charging mechanism, which is a QDMTT, which is very much a charging mechanism, just through different forms of the math, basically chirp away at the pie, per se. So let's see. So then, that said, I think we are ripe for another polling question. So let me see. I think if I click here, there we go. So has your company modeled the full scope globe calculation for a single jurisdiction?
Yeah, so what I think we're getting at here is this is the difference between doing transitional measures calculations, and then deciding that actually the full model rules calculation somewhere, and then attempting to do that and working out whether or not all the data to be able to do that calculation is available. I've got to say, full model rules calculation. So our when we first produced the Forvis Mazar Pillar 2 tool, the easy part was the transitional measures calculations, and it's taken a lot, and I know it's taken us separately and now together quite a lot of time to make sure that the full model rules calculations and all the data points are all correct. So it's definitely a much more of a challenge, this one. So similar, I guess that's just sort of slightly down the yes, is like if we think 29% of people think that they're going to be within the rules overall, only a small fraction of them have not had to do a full model rules calculation. I think that's how I read that. But yeah, it's be interesting to find out how easy or difficult that was. Right, so let's move on from there.
So yeah, so let's talk real quick about QDMTTs, because we're gonna, I think so. We've covered what the full scope globe calc looks like. Right. We're gonna now talk about what makes a domestic minimum tax a qualified domestic minimum tax under the globe rules. And then thereafter, we'll transition over to the transitional CBCR safe harbor and the transition years relief that you get. So real quick on this. So, the February administrative guidance in 2023 talked about, it basically addressed QDMTTs, because the globe rules for, when first released talked about, alluded to at QDMTTs, but the February guidance basically was kind of like the regulations to the code in the US context to what gives, what is a QDMTT. And since then, it's actually been incorporated into the globe commentaries through a consolidated one. So it's here to stay. So, in a nutshell, a domestic minimum tax, is going to, there in the model rules, there's this talk about a peer review process by every country and by a local authority to determine two things, right? Whether a domestic minimum tax is functionally equivalent to the globe rules. And in so doing that, you have to think about two principles, and this is what they talk about in the February guidance. They mention that the minimum tax in question must be consistent with the design of the globe rules, and we'll allude here in a second of what that means. The second component is that the minimum tax in question must also provide for outcomes that are consistent with the globe rules, right? In many cases, if a QDMTT is exactly what the IIR, top-up tax mechanisms are in the globe rules, that would ideally mean that it's probably a full it's probably a true QDMTT, a qualified domestic minimum top-up tax under the globe rules. So let's start with the first component here. What do they mean when they say consistent with the design of the globe rules? So in so doing, the OECD acknowledges that there will be a modest degree of variability because, the OECD is not law, right? They are procured by 140 different countries that, you have different commentators from different countries, and this is their attack, well, not attack, but more of their way of getting to this one unified approach, right? That will be used to collect top-up tax. So in so doing, they know that different countries have different laws, and our Congress could enact a QDMTT that has some differences than what Germany's QDMTT looks like. So a modest degree of variability is expected and acknowledged by the OECD. However, they mention that they must follow the architecture of the globe rules using mechanisms that are substantially the same as those calculated in the ETR and top-up tax payable under the globe rules. What they mean by this is, it has to be computed based off the same mechanisms that make globe income. You have to, you think about the same adjustments there. You can have substance-based income exclusion amounts, things like that. And I'll talk about where you can kind of claw back away on this degree of variability here. It must be also close enough to the globe rules that the M&E group that's using the same 252 data points and doing that top-up tax calculation can probably do it with that, do the QDMTT with those same exact data points. So that's an important one. That's acknowledged in the OECD model rules. Again, deviations are permitted, but it has to be in the context of, jurisdictional local laws, right? And this here is where it gets a little shaky, and this is why there's a peer review process talked about where you kind of look on a case-by-case basis going forward to assess whether this, domestic minimum top-up tax, meets this design component.
We asked the UK Revenue in that meeting I referred to whether that process, how that process was going to work, and they said not been set up yet. I know a number of jurisdictions have deliberately just basically lifted the model rules into local legislation because then it will automatically get a tick. I imagine that there will be some panel ultimately of OECD members that will assess those who have deviated, and those who deviate by the larger amount will run the risk of not being a QDMTT. The issue with that is that you won't get to keep the top-up tax, and others in the group will have to do the full IIR calculations and the UTPR calculations as if you hadn't got the top-up tax there at all. So it is in jurisdictions' interest to make sure any top-up tax becomes a QDMTT.
That's right. And then the last component here, right, just so we can get to the transitional CBCR components, right? So what we mean consistent outcomes, it requires that the local minimum tax produce an incremental tax liability of top-up tax that is equivalent that would have arisen under the globe rule. So like, for example, let's say, there is a top-up tax that is at, say 15%, and, one's at like 15.1%, right? Because of a QDMTT, that's a consistent outcome, right? What they're looking at is that you're in the ballpark, really, in plain sight. You're in the ballpark when this QDMTT gives you a result that is for your jurisdiction, right? That is basically in the ballpark of what the IR would require. It's very clear that UPEs, M&E groups, and constituent entities in that minimum tax must, and it's a non-negotiable point, must correspond to the globe rules definition. And here's where you can see some problems, I think, as QDMTTs start going live and different countries take different approaches, because certain entity types might get excluded, and then now you open up kind of a different kinds of questions from different areas. So there's that component. It has to take into the one thing that's also non-negotiable is it must take into account the 15%, right, and it has to follow adjusted covered taxes and globe income the way it is now. One thing you could have, right, is a QDMTT that doesn't give you a carve out for like tangible assets but does it for payroll expenses. That by the globe rules would meet both of those components. And there's a good example in the February guidance. They talk about that. So if a QDMTT were to say, no, I'm not going to include a carve out for assets, but I'll give you one for payroll costs, well, that won't invalidate it as a non-qualified QDMTT. It just means that it's a penal tax, but it'll get you closer to the 15%, which they're seeking to achieve. So to wrap this up, right, if systematically, you would have a greater, tax, under the QDMTT than the IIR, then you're probably doing okay, right? Meaning that if it falls below, your QDMTT puts you below the 15%, well, you might have an issue a little bit with QDMTT, and and the peer review process is, which to Neil's point is still being fleshed out by the OECD, might reveal that and cause, some disruption. So this leads to the elephant in the room about the US and CAMT. So, many people ask, is CAMT a QDMTT? And I'm going to tell you my opinion is no, it is not. And these are some of the reasons why. The first piece is the applicability threshold, right? So Pillar 2, a QDMTT requires that you have globe consolidated revenues of 750 million euro or more for 2 of the 4 fiscal years. CAMT requires, adjusted financial statement income over a 3-year period in excess of 1 billion. And AFSI in that context is kind of similar to net income. So it's kind of a higher, it's not exactly net income, but it's a little bit in that range. So, it's more narrower. So yeah, that's a big no-no from the peer review process. The second piece is CAMT does allow for certain jurisdictional blending to happen with respect to foreign branches in there. That's a big no-no for Pillar 2, because it's, one of the fundamental principles of Pillar 2 is it's strictly on a country-by-country basis. No cross-netting, right? And that's why one of the reasons why GILTI is not an IIR today. You can take German losses and net it with Spanish income, right? If you with 2 CFCs under GILTI, but you can't do that under Pillar 2 if it's a qualified IIR. And then of course, CAMT, gives you tangible asset depreciation. Pillar 2 is a little more generous in that sense. They give you a carve out for both tangible assets and qualified payroll expenses. There's a variety of reasons out there, but these are just some that come to attention that we wanted to bring to light. So that said, I think we're going to kick us into the transition years. But before we do that, are we? No, we're not ready for a poll question, are we? Yeah.
No,
okay.
No. But what I would say though is, we've got about 2/3 of the way through the slides, but 3/4 of the way through the time, Justin. So we'll probably need to some of these slides condense some of the discussion a little bit. Transitional safe harbour, we've discussed briefly. There's UTPR, and then there's potentially permanent safe harbours. So there's 3 transitional safe harbours. The de minimis test, which is, I think, 1 million of profit, 10 million of revenue in a year, simplified ETR, which will cover a little bit, but basically revenue per jurisdiction divided by, current plus deferred tax divided by revenue, and the routine profits, which is the SBIE. The once out, always out rule can be complicated for people here. So if you fail all 3 of the tests in 1 year and then meet them in the following year, you can't go back into the transitional rules. You have to continue with the full model rules after that.
That's right.
Yeah. So the CBCR and the qualified CBCR is something that we're seeing, a number of clients come to us on. The country by country report hasn't really been used for very much before, and certainly some of my clients have been quite open that they haven't put as much effort into producing something as they would do for something which had a fiscal impact or something which they thought was going to be shared between multiple tax authorities. Well, the new country by country report, or the country by country report under Pillar 2, is that. So we're seeing clients looking for reviews of their CBCR. Is it in line with the requirements? And in some cases, people are asking for opinions from us as to whether or not we believe it would be qualified. There are certain structures which just don't fit within the transitional safe harbours. So if you have stateless, as it says here, multi-parented groups, Also, tax transparent entities, which is a significant problem for my client base in financial services, because we quite often have fund structures which are wholly or nearly or definitely controlled within the group, and you can't use the transitional rules for those. So some structures, JVs as well, sometimes automatically fall within the full model rules for at least part of the group. So you already end up with trying to identify where you're going to get the full set of data. So I think the transition period is broadly 3 years. Obviously, it depends. If you've not got a December year end, then there's a little bit of flex around it, but nonetheless, it's broadly 3 years. Even if everything is within the safe harbours, you've still got to complete the GIR. Have I missed anything there, Justin, that we wanted to cover particularly in this slide?
I don't think so. We're going to talk a little bit, I guess, probably rather quickly on the 3 transitional CBCR tests now, I think.
Yeah, so this is the de minimis, which we just discussed. So 1 million and 10 million, those are the key numbers here.
And I would add also on there, it's important to keep in mind that the transitional CBCR safe harbor is the data set. I want to just to reiterate the data sets you're using. You're using your CBCR data, your qualified financial statement data that goes into the CBCR, and you're using your actual globe substance-based income exclusion amount data. So this is not CBCR information. This is the data set that would be required for the globe calc to do the routine profits test, which we'll talk about there. And then because of the December 2023 guidance, and we'll talk about that when we talk to the ETR test, there is the hybrid arbitrage arrangements you have to think about. So the de minimis test is 10 million euro in revenue plus 1 million. It's an and test. It's not or. You need to have both, right? So that's a rather easy one to follow. But the ETR test is a little more tricky when you're running the transitional safe harbor test, and this is where you have some of the complexities. So the first thing is, they say in there that this is meant to be simplified, right? You're not going to you can't use corresponding book to globe adjustments that may be in your fact pattern today and putting it into your calc today, right? Even if you would use it in the full scope calculation. That was disposed of in the December 2023 guidance. So what goes into this test? To figure out it basically says, what is my simplified ETR using CBCR data and comparing it to the rate today, which is 15%, right? Eventually, I think next year it's 16, and then eventually in the last year of the transition period, it gets to 17. But to figure out the simplified ETR, you have to make a couple of corresponding adjustments. So to speed this up and give you guys a little more context, you have to adjust for certain hybrid arbitrage arrangements that are discussed in the December 2023 guidance, which is really like deduction, no inclusion regimes, duplicate loss regimes, duplicate tax regimes. Certain adjustments have to be made at the numerator and denominator depending on the type of adjustment. Uncertain tax positions has to be reversed out. So if there are UTPs in that jurisdiction, that must be reversed out as well. And covered taxes, are really when you're looking at your simplified income tax expense, you're starting with current and deferred, but do not include you wouldn't include a QDMTT in there because it's a Pillar 2 tax. They tell you to follow these current deferred to follow what the Pillar 2 model rules say. So that said, let's kick it to the routine profits test. With the routine profit, what we're doing is going through all 3 of the transitional safe harbor tests. The first one was a de minimis. The second is the ETR test, and the third is the routine profits. All the rules say is you just got to meet one of the 3 in each transition year and you're okay. But if you fail all three, once out, always out, right? You have to go into the full scope calculation. What routine profits test says as the third rule, which some companies in my experience have decided to forego doing just because it's a rather cumbersome exercise in getting the data, and it doesn't always lead to the best result. So it's kind of not a super valuable lift. Is you basically take your, if your substance-based income exclusion amount for the year exceeds your profit or loss on the CBCR financials before tax, well then you're okay. You pass the test. But if it exceeds it, you fail. So and the rationale is, you would get under this data, you wouldn't pay any top-up tax because your excess profits are nil or negative, right? So you wouldn't tax a negative. Things to keep in mind for that. I won't spend too much time talking more about this, but just in the interest of time, we'll keep going there.
I think maybe we were due to move to the polling question now, were we, Justin? I think we're around 50 minutes. We probably want to move down to 39. I don't know if I can push that here.
Oh, there you go.
Yeah. So I guess what we're asking here is not just are you going to fail all three tests, but are you going to be outside as a result of being deliberately excluded as part of your group? So do you have investment entities? Have you got JV structures in there? So the organizational part of the transitional CBCR tests. I think on the questions, so I've been trying to answer the questions as I've gone along, but I started on question 9, and I don't know if there's 8 questions at the start that I haven't covered. There's a few questions towards the end that I'm not there. A replay of the webinar, will that be available? Yeah, that's not. I hope so. But not for CPD. I'm pretty sure that we will post links. I haven't answered either because of my sort of technical skills on this, or because we just don't get to them. We will send around answers to everybody who has registered. So just because we haven't answered a question in the chat doesn't mean we're not going to answer it. So sort of pretty similar, quite a high percentage of yes, look, Justin, on the sort of organizational exclusions. I think that sort of slightly surprised me. I think you were going to cover maybe the UTPR.
Yeah, so let's do it in the interest of time. Let's do a quick overview of the UTPR. Right, so the UTPR isn't live today. It goes live in 2025, but it's relevant today because in the July guidance, right, that we received last year in 2023, basically there is a UTPR transitional safe harbor for ultimate parent entity jurisdictions that is provided during the transition years. Really starting next year and then maybe a subsequent year after that, depending on your facts. And basically what it says is if, you can keep these slides here after that, but just to sum it up for the interest of time, what it basically says is that if the ultimate parent entity jurisdiction has a statutory corporate income tax rate of at least 20%, right, including extra jurisdictional taxes, so like state and local, all that stuff, if it's at least 20%, you are okay. You're okay with that jurisdiction particularly, and you're okay during the transition years. So this comes into the question, what happens with the transitional safe harbor, right, CBCR safe harbor and the UTPR safe harbor. I'm not sure it's directly clear in the GLOBE rules, but I would recommend those that are in that, specifically in the U.S., where you think you could be failing it may make sense if you meet the eligibility requirements of the UTPR transitional safe harbor to rely on that. So okay, let's keep going here. And again, it's available to M&E groups that are in the initial phase of their international activity with constituent entities in no more than 6 countries. You look to a certain mechanism, and it's elective. So we'll keep going through here since it's not relevant today, but it will be relevant starting in January for those that are looking to provision for this. So if there are any questions on the UTPR transitional safe harbor, please reach out to us.
Yeah, I would say that we're seeing this actually being relevant both in some of our clients and certainly in ones that we're auditing. So because there's a requirement in the 2024 financial statements to talk about what the effect will be in future years, and if you fall below 6 jurisdictions, UTPR will not apply in some circumstances. We are seeing some clients looking to deliberately exit jurisdictions prior to the rules coming into force so that they fall below the 6 jurisdiction number as a planning opportunity. So you've shrunk the number of jurisdictions that you have permanent establishments in. Obviously, it's not relevant for everyone, but for those who are on the sort of borderline and have maybe some small operations in some jurisdictions, they're moving whole staff members and operations out of those jurisdictions. So I think it is, for a limited subset of people, it is relevant. Yeah, so the penalty relief is important. We asked the UK Revenue about this, but they're not currently they're currently very much in carrot mode, trying to persuade people to participate and to get ready. I think they acknowledge that ultimately they will move into stick mode and start threatening people who in particular have made no efforts whatsoever to be ready for Pillar 2, and that's still, we still see some small operations in early implementing jurisdictions whose head offices are in non-implementing jurisdictions, particularly in the Middle and Far East, where those implementing jurisdictions are struggling to get traction with the head office. We expect that the population not getting ready is going to diminish fairly rapidly over time, particularly when people understand the penalties, which can be extreme.
Neil, do we want to transition to the last polling question and then cover this last material here? Just in the interest of
we can do. I think we only need like 3, right? But yeah, we can do that if I do that. So, but this is the obvious question for us to ask, really. We've got there's a large range of participants, so thank you very much everyone for attending. There's some technical areas that we haven't managed to cover. Some of which we will aim to cover in the following 9 sessions, but ultimately if there are areas of particular detail that you're interested in, they're almost certainly areas that we will have considered previously. So if you have any questions or would like to know more, please let us know. That's us there. I don't know, Justin, did you want to cover the last bits? I think we're probably pretty much there, to be honest, in terms of the content.
Yeah, I mean, I think we're good on there. I mean, if there's any questions, I know we went a little over here. If there's any questions anyone has, you all have the slides there, and if there's any questions that pop up, and if you're interested in discussing more, Neil and I are both more than happy, and anyone in the global network are more than happy to address those and discuss those further. Yeah, I mean, thank you everyone for attending, and we understand your time is precious, so we really do value you taking your time out of your day to sit here and hear Neil and I talk about Pillar 2.
Our pet subject. Fortunately, we don't meet up in person all that often, because otherwise that'd be putting everyone to sleep in the bar, wouldn't it? But yeah, I'll echo that. Yeah, thanks everyone very much for your time. I think we've finished up now. So I think we'll go to outro.